This is the time which Bitcoin would typically peak. We're in the later stages of the bull market. This is not where easy gains are made anymore. Momentum destruction underneath the surface of the price has been the marginal buyers being Bitcoin treasury companies and the ETFs. We will see massive volatility expansion at certain times. You'll start to continue to see outperformance from some of the other crypto assets. For the Bitcoin treasury companies, the well-managed one, there'll be like a delineation and you'll start to see sort of a divergence.
Bitcoin is a commodity with no common issuer or pre-mine, but also with a fixed supply. And then you have these assets like Ethereum that doesn't really have a known supply. From the treasury standpoint, how does it make sense to buy an asset that's not clearly defined, has no fixed supply?
Yeah, so I mean,
we are going to jump right in with my friend Jamie Coutts. He is the chief crypto analyst over at Real Vision. They do amazing work, and especially what I love is the work on global liquidity, on macro. We're going to dive into the 4-year global liquidity cycle. Is the Bitcoin 4-year cycle intact? Are we going to peak at the end of this year? What will the price of Bitcoin be? What's going to happen with Bitcoin treasury companies, with digital asset treasuries like Ethereum, the crypto market, and so much more? It's an amazing interview. Let's go ahead and jump right in, and don't forget to hit subscribe on that channel so you don't miss more of these. All right, let's go. Jamie, thanks for joining me. I have been looking forward to this conversation, and we just spent so much time talking offline, but let's just jump right into it. I have a bunch of topics and questions for you, but anyway, thanks for coming on. Appreciate it.
Yeah, thanks, Mark. I'm glad we finally got to do this. It's been a couple of months in the making.
Yeah, well, we tried to hook up in Australia last year, and then we're trying to connect here. But I love the research that you do. I love the research that you do and Real Vision does. I know in the Bitcoin space, a lot of people just don't like Raoul Pal and they don't like Real Vision, but I think you guys do great work there. I'm not going to buy your NFTs, but I appreciate the macro research.
I don't own any NFTs.
All right. I know Raoul loves those NFTs. But let's jump right at the top and try to understand where we're at in this cycle, where we're going. Macro, 4-year cycles, global liquidity, Bitcoin, crypto, Bitcoin treasury companies, DATs, all that. So let's start at the top though. So, I love the macro research that you guys do. Why don't we just start off? Can you just frame out where we're at right now? This is 9:15. We're about a couple of days away from Jerome Powell at the Fed making some big announcement. Where are we at in this macro cycle right now? Frame it up.
Yeah, so I mean, if people are following sort of the stationary models for crypto, then we're at peak of cycle, right? This is the time which Bitcoin would typically peak and would be sliding into a bear market sort of by next year. Now this cycle has been very, very different. We can talk about like what a cycle actually means in crypto, because it does mean different things to different people, but also people are now hypersensitized to the word cycle, and therefore everyone talks about it. Where I think we are though is we're in the later stages of the bull market. Like, this is not where easy gains are made anymore. Bitcoin is 6x from the lows in 2022. But I still think there is more upside. And the reason why I think there is more upside for Bitcoin and for other crypto assets is that, we've had a extraordinary or a very different period coming out of the last bull market, which was really just a hangover from the excess liquidity that was pumped into the system because of the COVID madness. So the fallout obviously has been higher consumer price inflation, but also a deficit in the US and in most Western governments that has exceeded the growth in economic growth. And therefore, you've got a problem with too much debt, not enough liquidity, a business cycle, which is incredibly important and ties into the crypto cycle, that has been more or less been in sort of has flatlined, hasn't really been in an expansion phase. It's the longest period where the business cycle has remained, or the ISM has remained, under 50. But that has changed the duration of the cycle. And therefore, we're at a point now where it's clear that the business cycle is starting to improve. Corporate earnings are dramatically improving. Positioning in risk assets, if you look at equities, is not euphoric. And you've got this problem that the central banks are, patently aware of, that they have a system which is incredibly indebted, where the amount of debt has increased way more than the liquidity that they've allowed back into the system through interest rate policies or through central bank balance sheet activities. And I think that gives us a liquidity impulse and upsurge towards the end of this year and into next year. So my view is that this market extends into sort of the first half of next year, and then it's sort of anyone's guess as to where the peak might be. But we at Real Vision have the frameworks basically to outline probabilistically when things are going to turn.
Right. Would you say that global macro markets fundamentally changed in 2008? So we got the introduction of QE. We got all the central bank balance sheets have been overly levered up at this point. And it looks like, in my opinion, previous to 2008, they sort of allowed the markets to sort of deleverage, which they tried to do in 2008, and things fell apart too fast. And they said, oh, we can't do that, right? We levered the system back up. And since then, 2019, obviously 2020, the banking collapse in 2023, anytime there's been even the slightest hint of some sort of deleveraging, the banks collapsed in 2023, it took 6 days to get a bailout. And it just seems that now the system has become so levered up, but not just that, the appetite, the willingness to allow any deleveraging has also changed. The amount of tools that they've implemented to prevent that deleveraging have been radically changed, especially since COVID. And you mentioned the amount of deficit spending and debt spending that's really driving the market. So do you think that, this 4-year cycle could be changed based off of the government's ability to stop adding liquidity, or wanting to stop adding liquidity, or willingness to? Is it almost like a policy thing?
Well, I always talk about investing is really playing like this game of chicken with central banks. We know what the game plan is. And so I think that they're always going to step in. And now you've got the government, we're in a sort of fiscal dominance regime. That's been the shift, I think.
Right.
That's probably most important to understand in terms of cycle work, because if you think about cycles being driven by liquidity, yes, the Bitcoin halving definitely drove cycles, but it's become less and less important. But it also just happened to coincide with this cycle, the liquidity cycle, which tends to operate in a 3 to 5 year time frame. Yeah, everyone says it's 4 years, but really, why is it on a 3 to 5 year time frame? It's because it's based on the duration of the debt at the sovereign level.
Right.
Now, sovereigns will fund themselves through an array of different maturities, but the average has been around this sort of 3 to 5 period. And that's just what has looked like a 4-year cycle, which was attributed to the Bitcoin halving cycle. I think it was always there. If you go back to 1998, there was a recent report, which I think that you got as well, which I published, was looking at sort of what happened in 1998 around LTCM. The central banks have always been willing to step in, but the events were so infrequent, or relatively infrequent as compared to today, that they were generally slower. But they always show their true colors. I mean, they've got this dual mandate, which I think is a facade. The actual mandate is to ensure that there is no default of the system.
Yep.
Right?
Yep.
Because they are, in the case of the US, they're definitely a private entity. It's different setups around the world for other central banks, but essentially they're there just to prop up the banks, the commercial banking sector. So the cycle itself now is, because of fiscal dominance, is morphing again. And this is work that we're looking at. Raul's definitely looking at it. Raul and I do independent research, but it's all on the Real Vision platform. But we have sort of the same frameworks. He's informed me so much in my process over the years. But I was having this conversation with him just the other day. It's now that so much of the liquidity is now being driven out of the treasury by issuing short-term debt, what does that mean for the liquidity cycle, the traditional liquidity cycle, where they used to operate on a fairly standard maturity sort of program? and we could sort of time it within sort of 3 to 5 years, and it's changed. And so I think that not only was the excessive reaction to COVID the reason why we've got an elongated cycle this time around, but also now the US since 2022 with the Treasury doing what it's been doing, maybe these cycles get shortened, maybe there's more volatility, because once you start stuffing in all the debt at the short term, at the short end, stablecoins are great. That's going to find a whole new bunch of buyers for the toxic debt of the US. But anything that goes wrong, is much more. It's susceptible to cause flashpoints in the financial system, because they'll need to be very, very quick to step in, even more so and even more unorthodox than before. So the Fed's just basically tied to the US debt wagon at this point.
So then, are you saying something changed in 2008? And it's
2008 was when basically the U.S. government took on the debt of the banks,
right?
And bailed them out.
And so with the short-term debt that we have building up, and the leverage that's been built up that can't unlever, their willingness to act, potentially any disruption that comes, they're going to step in right away, just like we've seen in the past, and that could disrupt these cycles as we've known them.
Yeah, I mean, I just think that what the Treasury has done is new, and that needs to be incorporated in sort of forward thinking about what cycles will look like. But like the trajectory doesn't change,
because it's not just the U.S. Treasury, right? Because like in London, for example, the BOE has been cutting rates, but like the long end is blowing out, right? So we see other central banks that are like getting maybe losing control of their bond market. Japan's having a problem with theirs, and so what happens? Then they have to start printing to control that long end of the curve. And anyways, that's kind of some of the things that I'm thinking about. Like I feel like the cycle is in effect until it's proven to be otherwise, but there's a lot of things that are happening that seems like maybe it just won't play out exactly like we thought it did before.
Yeah, well, that's already proven to be the case. If you held the view going into this year or this cycle, was that it was going to be a standard 4-year cycle.
Right. So as you said, I think when you first kind of opened up, you said, I forget the word that you used, but if you looked at these things kind of frozen in time, we should be peaking right around here somewhere in the next month or two. But these are moving targets, right? And so it's like, well, let's just see what happens in Q1 and we'll let you know in Q1 sort of what the policy is at that point.
Every day we see headlines about inflation and debt and diminishing control over our own money. That's why I always come back to Bitcoin, because it's built for generations. It's built for legacy. But protecting your Bitcoin legacy the right way, it's not always simple. It demands discipline, focus, and the right partner. Now that's why I personally use Unchained Signature. It's a premium private client service for serious Bitcoin holders who want expert guidance, resilient custody, and an enduring partnership. Now with Signature, you're paired with your own dedicated account manager, someone who understands your goals, helps you every step of the way. You're gonna get white glove onboarding, same day emergency support, personalized education, reduced trading fees, and priority access to exclusive events and features. Unchained's collaborative custody model is designed to provide the same security as the world's biggest Bitcoin custodians, but for those who prefer to hold their own keys. Now, I've been using and recommending Unchained for years. I even got my parents to set up with them. So if you want to get set up, check out Unchained Signature at unchained.com/MarkMoss. And as a loyal listener, I got a discount for you. Just use code MOSS10 at checkout to get 10% off your first year, because your Bitcoin isn't just for life, it's for generations.
Yeah, I mean, look, I don't think there's, the same, like the risk models that I have built around Bitcoin, they don't scream euphoria. We had euphoria in sort of Q4 of 2024. So look, if the cycle ends, we'll all look back and say Q4 was really the top in the on-chain data and all the risk metrics, in the same way as May of 2021 was really, that was the real top of that cycle, because it took out all the momentum. And so yes, we went higher, but there isn't really in the most recent run up to 125,000 in Bitcoin. There wasn't screaming euphoria. One of the reasons maybe we can get into as to why there's been sort of, momentum destruction underneath the surface of the price has been the marginal buyers being Bitcoin treasury companies and the ETFs peeking into that cycle, and them basically declining quite rapidly since then. So that is the critical swing factor for Bitcoin, but that will follow the liquidity cycle. So if liquidity picks up, the ETF buyers will return, the Bitcoin treasury companies will see maybe not falling MNAVs, maybe expansion, who knows, but their capacity to buy and become, and get more involved in buying Bitcoin will increase.
I want to definitely get back into that topic a little bit more, but before we do, I'm curious what you think about Bitcoin's CAGR. So depending on what time period you take a look at, right, maybe it's a 50 to 60% annual compounded annual growth rate over the last 3 years, 3 to 5 years, maybe 85% if you go back 5 years plus. The general rule of thumb seems to be that the law of large numbers says that number continues to decelerate, and we go from 80 to 60 to 50 to 40 to 30, et cetera. What do you think about, or have you thought about the potential for CAGR to actually start to reaccelerate again? And the reason why I ask that is if you think about like traditional assets that would be probably started from a venture capital round, and they've got all the private equity money in before they go public. And then you start having retail, which is small incremental money that kind of comes in. And so as the asset gets bigger, it's big checks first, small checks later. Whereas like Bitcoin seemed to work the other way around, where it was little checks in the beginning. And today, to your point that you just brought up about the Bitcoin treasury companies, now we have billions of dollars of buys coming in at a time. And so now with the treasury companies, with the institutions, as you mentioned, the ETFs, with even sovereigns coming in, could we be sort of, looking at technology with an S-curve type format, could we sort of be in that parabolic phase with the big checks coming in that could potentially invert Bitcoin and see that CAGR start to accelerate it again a little bit?
I think what's offsetting that hypothesis, Mark, is that you've got now, in the early stages, spot buying only. And you had the uniqueness of the hard cap as well with the declining inflation rate. Mm-hmm. That was perfect for parabolic rises, especially when it was just the plebs, us buying it. Then as the network evolved, and I guess more sophisticated players,
the futures, the options, etc.,
suppressing the volatility. So I even look at the research that I do. I look at the elasticity of Bitcoin to changes in liquidity, which is, anyone who says there's a perfect metric or a perfect correlation in financial markets doesn't understand financial markets, because markets are non-stationary. But at least historically and still today, the relationship with liquidity is statistically extremely significant, but it is moderating over time. And so looking at sort of just the last couple of years, Bitcoin's elasticity to the changes in liquidity is less this cycle than in the last cycle, but not by a massive amount. And just where we are in the liquidity cycle is typically when you start to see a real uptick, and therefore the elasticity generally expands also during this period, but more so in the same sort of scenario from previous cycles. So I just look at that and I think, okay, you've got suppression of volatility, and you've got just the maturation of the market, and the sensitivity of the asset to the drivers of the price starting to decline. So I am in the camp that we start to see CAGRs moderate over time. But it's going to be interesting because there will be explosions of volatility in and along the way. And if you look at why you invest in the S&P 500 from a traditional portfolio management standpoint, is that you stay allocated, because if you try to time that market, generally 80%, 90% of the returns come from 10 trading days in the year.
Right.
Same applies for Bitcoin. And we will see massive volatility expansion at certain times, like we saw in 2023 with the bank bailout, and the first time that Bitcoin basically gave the signal that this is a systemically integrated asset with real risk-off characteristics, because the interbank market exploded. Bitcoin always fell in those scenarios. It didn't that time. So it was another sort of proving point. And I think we'll see a lot more tests like that, where Bitcoin will show that it is truly a risk-off asset, and sort of shrug the criticism that it's just it's a risk asset correlated to the Nasdaq, which is not true.
Yeah. I mean, certainly in the last 5 years, the Sharpe ratio has been much better than U.S. Treasuries. And we can see how since the introduction of the ETFs, the volatility has really come way down. So
it has, I think, yeah.
It's like we could just continue just sort of being boring and just continue creeping higher and higher and higher, maybe. You mentioned the global liquidity and some of the elasticity that's sort of diminished there. Real Vision, Raul talks a lot about global liquidity flows and sort of this potentially 8 to 12 week lag that Bitcoin might have to that global liquidity move. And so when you look at this global liquidity move right now and then adjust for this lag, I mean, it looks like there should still be another big leg up in front of us.
Yeah. I mean, the problem with using the lags is that markets are non-stationary, so it'll change over time, but directionally it should play out. Unless there's something fundamentally different about this asset that we're not aware of, and that it's not tied to the increase in marginal new units of currency in the financial system, which I don't believe to be true. So the problem is that Twitter has attached itself to this chart. I think it's been the most shared chart of 2025, and it's fixated on the lags. Raul said this many times, and I would certainly say it as well. It's like, if you're trying to invest on one chart with one correlation fixed with a fixed timeline that's been working for the last 2 years, then you're gonna come unstuck.
Yeah.
But yeah, you're right. Like that the divergence between the two is expanded, and it's not just M2, which I think is the most shared sort of version of that. It's total global liquidity.
Right.
So you're looking at central bank balance sheets, you're looking at the impact in the shadow banking market and everything else.
Yeah. So when you look at that, and to your point, certainly don't just focus on one indicator. But if you look at that plus a handful of other indicators that are commonly used, like MVRV scores, for example, or even if you want to look at Fibonacci lines, which I don't really put a lot of credit towards those things. But you look at some of these NRPL scores or whatever, it does sort of look like Bitcoin is maybe halfway through its cycle. Like from a is it expensive? Is it cheap? You look at the M2 lag. If you look at, again, these types of indicators, you've mentioned that, from a static time frame, like October, November sort of peak from a time frame, but from like I said, all these on-chain indicators, et cetera, it looks like maybe we're like halfway through. And so again, that's from a static view. Now we could see Bitcoin go on a $30,000, $40,000 rip, which would then put it to the very top of the peak real quickly, which then maybe does make me think, well, maybe it does hit that M2 lag. We do pop up. We do end up magically right in November here at the top of cycle, right?
Yeah, I think the best thing for Bitcoin, if you're in it for the long haul, is that you get sort of a moderate increase, because it's when Bitcoin goes parabolic that you generally find the crescendo top, because that's what encourages over positioning, increased leverage, which always gets unwound. And if it's unwound at a time when global liquidity is starting to slow or decelerate, it doesn't have to top. Global liquidity can expand well beyond a Bitcoin peak, and it has in the past. It's really about that subtle change or that rate of change. But if you have the ingredients of a parabolic rise with a massive explosion in open interest, and MVRV goes up, which is all the unrealized profit in the network, then you have the ingredients to form a top. This peak has been, we saw euphoric tops in intermediate or mid-cycle tops in Q1 of 2024, and I was calling it out then. In Q4 of 2024 again, which I was calling out again, which no one was willing to listen, because the tightening of financial conditions to the US dollar and liquidity was just not supporting it. But where global liquidity is today and where it kind of needs to get to stop anything from happening is still a fair way away. So I think that the trend itself is looking, it's tired because it does rely on liquidity, but we haven't seen a euphoric parabolic rise that would just take the wind out of the sails for the rest of the cycle.
One more question about this, and then we're going to move to a different subject. But Trump is a force to be reckoned with. He has been very aggressive towards Jerome Powell at the Fed. Lower rates. He calls them names like too late, et cetera, right? He's been extremely vocal. He wants rates, 3.5 points lower than where they're at today. It looks like potentially Powell's going to cave. Maybe we get a couple rate cuts this year. But it seems like one way or another, Trump's probably going to get his way. We know Powell will be out next year. He'll replace him with a Dove, and he'll probably get his way. And maybe this time next year, rates are 3 points lower. In that scenario, hypothetical, would that be enough, the U.S. acting alone, to influence the direction of that global liquidity?
Oh, massively, because if the dollar continues to decline, and so it's already had a pretty historic move in 2025 from sort of 107, I think it got even higher, it's down now 97. That's a big move in the dollar. It doesn't look like that move is over. But if the US were to aggressively cut, and I think the more important than the interest rate moves is the balance sheet moves. Like they're still doing QT now. At the margin, it's fairly small relative to where it was in the past, but it's still tightening the balance sheet, which is putting pressure on the financial system. And so that if there's a pivot there, it would be very meaningful for total global liquidity. It's driven by the dollar. It's driven by balance sheets. It's driven by volatility in the treasury market. So all those things would be very, very supportive, but it would also give other central banks the cover to do more.
Right.
So China wants basically the US to continue to do so. That gives them cover and takes the pressure off their currency as well.
Yep.
They already have been aggressive. They need to be a lot more aggressive, arguably. And I think the US move would just provide the cover, and it'd be open season again and would get a pretty big impulse.
Yeah. So again, we'll pivot from here, but I think Trump seems to get his way. He's a force, and I'm guessing he's going to get a Fed chair, and that he wants, seeing as he gets to elect them, and we could see a sustained drawdown all the way through next year. The Dixie is low, as you said, but it's still historically pretty high. So I mean, we have quite a bit of room to come down. That's what he wants. We'll see. So these are, I was going to just put a pin in this for everybody. These are moving targets. You can't ask anybody to predict where this comes out. These are moving targets. We look at it, as these indicators roll out. I want to jump into the next thing, obviously staying on Bitcoin for a minute, but one indicator that I think is sort of ridiculous, but seems to work, is Bitcoin dominance. And I say it's ridiculous just because, like, today on in 2017, if I can remember, it was like 2,000 cryptocurrencies. Today on CoinMarketCap, it's like 19 million. So it's like every time one new gets created, it brings Bitcoin dominance down. So it seems like kind of like an irrelevant metric in my opinion. But that being said, in June, around June 13th, June 15th, we saw Bitcoin dominance drop. Ethereum, and really maybe a better indicator is Ethereum Bitcoin. Ethereum seemed to take off with the rise of Ethereum DAT. And then all the Bitcoin proxies, as I call them, all the Bitcoin treasury companies all sold off at the same time. So while I like to think the indicator is somewhat irrelevant, it sure seemed to indicate quite a lot here. What's going on with that?
So Bitcoin dominance is really like, to the point that you're making about sort of the explosion in supply, in the sort of the altcoin crypto universe, yes. All of that takes attention away and distributes attention, which I guess, makes it harder. Like if it was a more concentrated space, but like that's just, for better or for worse, it's just a reflection of the growing adoption and expanding footprint that crypto has in the economy and in the lives of individuals, especially younger generation. The Bitcoin dominance chart is really I wouldn't think in terms of like the explosion in supply of all the worthless meme coins and all that sort of crap, but it's really a reflection of large caps in crypto versus Bitcoin. So what it shows is Ethereum and the other large caps starting to outperform, and the pattern plays out almost every cycle. Once you get to the point where the business cycle, the economy is growing, corporate profits are expanding, and they're beating expectations, margins are improving, capex is improving, generally you have a broadening out of risk. It's just human nature. And so whether you sort of see value in some of these other large caps, you do find at this point in the cycle is when they start to outperform. And that's what we started to see in sort of July. And you could see it in the ETF flows. There's basically a flip that happened. And I think, it was clear that Ethereum relative to Bitcoin had also become undervalued. And so whether that continues over time, it usually signals the last part of a bull market, because as that risk gets broadened out, and then, the increase in sort of attention that it goes across the crypto ecosystem, it brings sort of reflexivity that brings us closer to a top. And then everything underperforms in the next bear market. And maybe these assets don't underperform as much in the next bear market because there is legitimate adoption taking place, as much as there is fuckery going on in the activity data. It's unquestionable from my standpoint that adoption of blockchains is proliferating at a real clip. And therefore, what happens in the next bear market, I don't know, but like the volatility is so much higher, you have to make sure that you're thoughtful around your position sizes if you do want to go into that space.
It seemed back to your point about this end of the business cycle and the money sort of moving out on the risk curve, which of course makes sense. It seemed like, a couple things. So like number one, like when you're an institution that wants to place $1 billion, I don't think you can put $1 billion into Shiba Inu, right? So it's like, it seemed like the Bitcoin treasury companies were sort of like that next speculative play, right? A more volatile play than Bitcoin. So Bitcoin's a 1x, they're a 3 or 5x kind of a play, right? So it's sort of like the same potential volatility crypto returns, but in a regulated body. And it seemed like a lot of those crypto degens, the Bitcoin degens, latched onto all of these Bitcoin treasury companies that were up. I mean, half a dozen of them were up 3,000%, 5,000%, 8,000%, right? Metaplanet was the very best performing stock in the world last year. Equity.
Yeah.
But then when you see Bitcoin dominance roll over, like they all just fell flat on their face. And so to the point that you're making about it moved further out the risk curve, I don't know if that's necessarily accurate, because like I would say that those companies were pretty far out the risk curve.
Yeah, well, I mean so there was, I think, that mini bubble that took place inside the Bitcoin ecosystem that drew in maybe capital that would have found its way into the wider crypto economy and some of these other smart contract platforms and applications, but actually found themselves in the Bitcoin treasury companies. But that also, that's also reflexive as well. So there is an increase in supply of these companies and attention, and all is good once the demand is there. And that becomes the new marginal buyer and driver of the Bitcoin price, even more so than the ETF flows. At least there was in Q2 and parts of Q3 this year. But if there's MNAV compression, it just becomes harder to maintain the buying velocity. And then you sort of get that reflexive move where you've got less at the margin buying from that segment, and that slows down the price appreciation.
Yeah.
Markets are a funny thing. They allocate capital, in ways that you perhaps can't sort of foresee.
They're not rational.
It's sort of like it's a microcosm of like what's happened in previous cycles.
Yeah. While your point is sound, I mean, obviously those Bitcoin treasury companies were buying an enormous amount of Bitcoin, specifically, I mean, MicroStrategy most of all, and Metaplanet were buying a lot as well. And the ETFs were also buying a lot, but no matter how much they were buying, the price didn't seem to be going up in combination with that. It seemed like there was enough sellers for as much additional buying as there was, right? But we did see the buying. We saw a couple of times, was it 80,000 Bitcoin in a single day got dumped in and absorbed, with only a couple points being moved here and there. But my main thing,
that peak in like Q1 was off the charts.
Yeah.
I mean, what MicroStrategy were in terms of the marginal buyer, and then really into Q2 was the newer treasury companies. I don't know if we can ever see that. It's not so much how much they were buying; it's the rate of change or the acceleration of the buying at that point in time that was like the most interesting. And that peak, if you look at it on just a rate of change basis, was off the charts.
Yeah. Although when you can look at like BitcoinTreasuries.net and see all the publicly traded companies with Bitcoin, and if you take out the top couple, I mean, really just take out MicroStrategy and take out MetaPlanet, the buying, sure, the rate of change was a lot. Like companies were going from 2 to 4 to 24 to 100. So the rate of change, what they call the Bitcoin yield, was dramatic. But it was like, you bought 24. MicroStrategy was buying, 15,000 at a time or whatever.
Yeah.
So a little bit different. But my interest is mostly there. So let me see if you can tell me the future. Where does this go? I mean, do you think that, at the late stage of the cycle, Bitcoin dominance returns? Do you think money comes back to some of these proxies, or was it sort of like this, obviously with crypto, we have these bubbles, these cycles, if you will. Do you think this is like, first part of the cycle, shake some of the players out and then build up energy for the next one? What do you think happens when Bitcoin dominance returns, and what kind of time frame are we looking at?
If liquidity is rising, Bitcoin will rise, but I think we're in that stage of the cycle where you'll start to continue to see outperformance from some of the other crypto assets. It's just the way it generally plays out. I think for the Bitcoin treasury companies, the well-managed one, there'll be like a delineation, and you'll start to see sort of a divergence. If you look at all the Bitcoin treasury companies in terms of percentiles of their MNAVs, you'll see more of those companies start to drop into the bottom percentile, and that bottom percentile in terms of MNAV will go from like, 1 MNAV today or less down to 0.8 or less as they get sort of more and more distressed or out of favor. And so there'll just have to be a consolidation. And we'll look at this period in the next cycle and see much less companies that are pursuing this strategy. And you'll start to see the winners more clearly affirmed, I guess, by the market, because, you're involved in this space, and you know that, I would imagine, I'd like to actually find out from you what you think about this, but there's definitely going to be some acquisitions scooping up, going into sort of the next bear market and consolidation in the space, because you'll basically have the opportunity to buy Bitcoin at a discount. So I think that's how I sort of see it playing out.
I mean, certainly it's going to play out that way, but we're talking very broadly, right? So certainly there will be companies who find themselves at a point in the road where they can't raise any more capital. They're trading below net asset value, and someone's going to come along, make them an offer to give them an equity deal, buyout, and they're going to take it. So of course that's going to happen. Will that be the majority? Probably not. Not this early in the game, in my opinion. So a couple things. So number one, these are equities. So just because the equity price drops, the market cap drops, and they're below 1 times MNAV, net asset value for everybody, so they're keeping up. Mm-hmm. Why does that mean I have to sell my Bitcoin? So what?
They're just not buying.
Yeah, so what, right? Like I have my business, I'm generating revenue, I'm going to keep buying Bitcoin, I still have my Bitcoin, so what? Michael Saylor told me, he said, like, what's the worst that can happen? The worst that can happen is I can never raise money ever again, and I'm a $100 billion company growing at 60%. That's the worst, right? So with our company, with Satsuma, right, we raised enough money to buy 2,000 Bitcoin. I don't know what you put the long-term price target of Bitcoin, but in my opinion, that's about $2 billion worth of Bitcoin in 5 or 6 years. Of just NAV alone. Even if we never raise another penny again, 2 billion of NAV. Now, in the US, we have a word for them. We call them unicorns. If they reach $1 billion val, less than, I think it's 0.002% of companies ever make it to $1 billion val. So what's the worst that can happen? We're a $2 billion company in a couple of years. Right. So so what's the shakeout? Why do you have to sell? Right. So why are you distressed? So certainly what's going to happen in this space, I don't see it, but it is going to happen, is the nature of the game is I have to apply leverage, which is how I can earn that increased NAV. And some companies are too far behind, so they're going to use more leverage than they should be. And they're going to take a bad deal. It's going to be short term. It's going to be a 2-year debt term obligation. They can't keep up with the debt. It comes due at the bottom of the bear market. They're forced to liquidate. Certainly that will happen. I haven't seen that really built up yet. And I I'm sort of in tune with a lot of the companies here. It will happen. But I just think about that. And certainly to your point, yes, we'll see those acquisitions happen. I think it's a little bit early for that.
Oh, yeah. No, we're talking way down the line. I think this was a golden opportunity to get in and acquire Bitcoin and put it on the balance sheet and maximize the opportunity while the conditions were good. And I just think that, that even if this sort of gold rush is over, so to say, and that there's delineation, it was the right thing to do. You were using the capital markets to acquire the most important global asset of generations.
But I think Jamie, just to also expand this a little bit, it's a fun conversation to have, but I think there's a lot of tools at your disposal. So you think about like if the capital markets close off to you, right, for example, and certainly in a massive liquidity crunch and the whole market sells off back to 2022 or worse, 2020 or something like that, certainly it could be hard to raise liquidity. But for the most part, like there's I don't want to say unlimited, there's a lot of money available just in taking convertible debt, for example. We're talking billions and billions of dollars sitting there. I mean, we had people begging us to take their convertible debt and we were like, nope, we're not taking it. So like in a bear market, we could use debt. We could get it termed out at 3 years or 4 years, right? I mean, we believe in the long term. Obviously, none of this works if you don't believe in the long-term case of Bitcoin, but sure, I'll take 0% debt for 4 years. I'll roll the dice on that, right? So like we have that at our disposal. There's all types of options. There's bonds, there's Bitcoin bonds that are being rolled out. Obviously, there's additional raises, which get tough in a liquidity cycle. There's equity raises, at the market offering, which are tough when your MNAVs get compressed. And there's prefs and all different types. There's a whole bunch of tools that are available for good companies.
That's right.
So it'll be interesting. I don't believe that. I think it's. If you look at MetaPlanet, which is the first company that was able to duplicate the strategy, they've had, just in the last 12 months alone, they've had 12 drawdowns, or I'm sorry, it was about 18 months. In the last 18 months, they've had 12 drawdowns of 20% or more. 79% was their most profound drawdown last year. Their duration have lasted anywhere from 20 days up to 4 months. 119 days was the longest duration they've had. So instead of like one cycle every 4 years, they have like 6 cycles a year. And the MNAV isn't the most important metric. I think a lot of people put too much under that number. So for example, you could have bought MetaPlanet last year at 7 times and made a ton of money. And you could have bought it 2 months ago at 3 and lost your ass, right? So it's like the MNAV doesn't mean everything. But again, they had a 79% drawdown last year and returned 1,000 after that. So I think, it's just part of the cycle. They're extra volatile. That's why people buy them, for the extra volatility. So it'll be interesting. But what do you think about the DATs? And these are the digital asset treasuries. And let me frame up why. My audience obviously knows. For 4 years, I wrote cryptocurrency research. I decided to be Bitcoin only. I don't spend a lot of time focusing on cryptocurrency anymore. It's all just Bitcoin, right? So I can't debate 19 million different cryptocurrencies. But I was in London 2 weeks ago, and I met somebody that's launching a Solana treasury. And, I kind of told you before recording, he told me, he doesn't even know the bull case of what he's doing. But here's my thought on this. When I think about a Solana or an Ethereum treasury. So, Bitcoin is a commodity, right? It's, there's no common issuer. There's nobody that pre-mined it. There's nobody that has that control of it. And it has a fixed supply, right? 21 million. So I could see how a company would put a commodity on its treasury. I'd put gold, I'd put oil, something like that. But if you think about like Ethereum's bull case, for example, it's like the world computer, right? We're going to put everything on top of it and we're going to do all the smart contracts in this world computer, and Joseph Lubin and Vitalik and Consensus, they can control this algorithm and they're going to keep it working and blah, 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 whatever, right? The votes and all that. So it's like a tech company. So it's like Apple. Like Apple's 3 trillion. So like their market cap potential is 3 trillion. So Bitcoin's going for money, 500 trillion. They're a tech company, number one. Number two, again, it makes sense to put like a commodity on my balance sheet, but why would I put a tech company? We don't see typically companies putting other equities on their balance sheet. They're not allowed to. But it wouldn't really make sense to put Apple you wouldn't create a treasury company around Apple, maybe. And then the third point I'll ask, and then I'll let you kind of respond to these. The third point is then back to, again, Bitcoin is a commodity with no common issuer or pre-mine, but also with a fixed supply. And then you have these assets like Ethereum that doesn't really have a known supply. And so I'm just curious, I think you sort of believe in also those types of treasuries as well, but maybe you can fill me in on the bull case since the other guy couldn't.
Yeah, well, I think, so the way I'd frame Ethereum and these other smart contract platforms is that they are platforms, they're application platforms, which is just essentially a derivation of a tech company or a new type of tech company. So it requires a different framing when you're looking at them as an investment. And I think that Bitcoin obviously owns that commodity framing because of the supply schedule and because of the level of decentralization. Now, with Ethereum and the Solana and all these other platforms, you've got a case to be made that actually, they are going through an adoption curve, which is going to be pretty dramatic over the next couple of years. And I think that, with the amount of adoption that they've already gained, and that's putting aside, I guess, the activity metrics, which we do track as on-chain analysts in the space, which I think is a lot of it is gamed. And
you're talking about the wash trading.
Yeah, wash trading, but also just, there's, activity, there's cyber, attacks, and there's tons of stuff that inflate numbers. So you have to look at it sort of more holistically, but it's undeniable that you're seeing adoption. And now you've got basically integration with the financial system with stablecoins, and stablecoins are going to move on blockchains. Blockchains have facilitated the need for the US government to find new buyers of its debt. And so whether we like it or not, these platforms are going to facilitate a huge amount of global commerce.
Let me ask you about that. So yes, I 100% agree with you. The number one stablecoin, and not by a little bit, but by a lot, 75% of the market share is Tether. Mm-hmm. Paulo from Tether is a Bitcoiner, and they announced just a few weeks ago they want to move it all over to the Bitcoin blockchain. They're moving it to RGB, number one. Number two, we've seen some of the other players and new entrants are building their own blockchains. Mm-hmm. So they're not going to use Solana or Ethereum or Bitcoin. They're going to build their own. Mm-hmm. So it seems like the dominant player wants to move to Bitcoin, not Ethereum, and then the new entrants want to move to their own platforms.
Yeah. So is the argument whether you should buy Ethereum or one of these other platforms, or is the argument, are blockchains going to increase in terms of total usage?
I was more thinking about just from the treasury standpoint, where how does it make sense to buy an asset that's not clearly defined, has no fixed supply? That's what I was kind of trying to understanding from a speculative standpoint is one thing. Creating a treasury company around it and raising money in public markets seemed to be like a different animal for me.
Yeah, look, I mean, I know where you're coming from. I think it's a changing of investment philosophies all around. So let me give you an example of what I mean here. The Swiss National Bank, the central bank, started buying Apple and tech stocks back in 2016. That seemed crazy, right? But they understood the debasement game. And so they thought the best thing they could do with their asset, with their reserves, was to put that into tech stocks. And that proved to be an incredibly smart move.
Yeah, worked for them.
Unfortunately, not mirrored by a lot of other central banks. So, I mean, where is the growth happening in the global economy right now? If you look at the legacy financial system or the crypto economy is exploding, and putting all the gaming aspects aside, settlement values on blockchains are growing at 78% compound for the last 5 years. And that was really before government said, hey, stablecoins are okay. Now, the question of whether you want to take a investment punt on Ethereum versus Solana or versus, I guess, any Stripe's new platform or the new Tether blockchain, that's more like a investment decision which is a lot of risk, and therefore it becomes very tricky for these digital asset companies. And there's a lot more risk there with a platform that's in a hyper competitive space where there's basically no barriers to entry. It's just open software that anyone can fork or replicate. But there's also a thing called network effects, which are very hard to budge.
Yeah.
And so there's definitely network effects exhibited through the top smart contract platforms. But we'll see in 5 years' time what the right smart contract platform is or has been the best performer, if at all. I mean, I put Bitcoin at the center of my entire investing world because it is, in my eyes, and I think in the eyes of even sovereigns now, it is the emerging global reserve asset, and it is the clear leader and will continue to lead. But I do look at those other platforms as investment punts. But when you start looking at the digital asset companies in that space, you can argue that the high quality ones come first, and then it starts to tail off, and then you've got added risk that Bitcoin doesn't have because it is not a fix. It doesn't have the characteristics of the monetary network of Bitcoin. And the other thing that we don't mention, we haven't mentioned yet, is that the reason why Bitcoin is not only because of its monetary properties is a sound investment with lower risk of sort of downside over the long term is because of the energy aspect. It is gobbling up excess energy around the world, is now strategically important for companies that actually understand how to derive value for their citizens, that they bring Bitcoin mining into their economy and they subsidize it and promote it, because not only will it monetize excess energy, it will drive investment in a space which is directly linked to AI. And so that whole aspect just supports that network growing even faster. So is this, I guess, to come back to the original point, there is a lot more risk, a lot more uncertainty in putting any other digital asset on the balance sheet. But still, there's an argument to be made that the underlying smart contract platform assets themselves, the ones with network effects, will continue to outperform, outperform tech stocks, for instance, maybe not Bitcoin, but should do well. And, you allocate with the right sort of position size to that because of the volatility and the uncertainty.
Yep. And that's a question that I kind of always come back to, in regards to the equity side of these things, is as a Bitcoiner, we're always is this going to beat Bitcoin? But most of the world doesn't think that way. They're just does it beat the S&P 500? Does it beat inflation? And so they're sort of building out their basket, sort of a thing like that. Man, there's so many other things that we could dive into, but I think we're probably just going to wrap it up right there, Jamie. But I would like to do this again sooner. Maybe on the next report that you have out, we'll come on and talk about the report. And I wanted to get into some other topics, such as talking about location sovereignty. So maybe we'll table it for another talk. Again, like I said, your research is amazing. Just tell everybody what kind of stuff you do and where they can find it.
Yeah, so I'm the chief crypto analyst at Real Vision. And we've got a platform which is basically pretty much focused on all the exponential technology plays, but primarily crypto and how that plays into the whole macro framework. The business cycle analysis that Raoul does and Julian does is by far the best business cycle analysis out there. I focus strictly on macro and crypto. So if you're interested, check us out.
Yep, we'll link to that down below. And he shares his reports with me. I've done some YouTube videos on him, so just look out for that. We'll always link back to that. Jamie, thanks so much for taking the time. Appreciate it.
Thanks again, Mark. I loved it.